Hi, everyone. Welcome to today's deep dive. We're pulling back the curtain to look at how the gears turn inside corporations, specifically focusing on shareholder voting.
Right. It's this fundamental mechanism, really the bedrock of corporate governance.
And it lets the actual owners, if you hold stock, influence how a company behaves.
And it's become, an increasingly powerful lever, especially as issues like environmental, social, and governance, or ESG.
Those have really moved front and center, haven't they?
Absolutely. Right into the boardroom conversation, not just on the fringes anymore.
That's right. So our mission today is to really get inside that mechanism.
Hmm.
What are the core principles guiding the big investors, the ones holding massive amounts of stock?
What policies do they follow? What do the votes actually look like? How do they work?
Yeah, and we're going to dive into some fascinating real-world battles and, crucially, see what the research tells us about whether this all actually makes a difference.
It's about understanding how something that can seem, well, quite technical, profoundly shapes the companies around us.
Okay, let's unpack this. At its core, it's about power
Right.
and delegation.
Exactly. You, as an owner, have rights, and voting is perhaps the most direct way to exercise them.
And for the really big players, those huge institutional investors, there's a key principle driving how they think about their ownership. It's called active ownership.
hmm That's highlighted by Principle, two of the UN Principles for Responsible Investment, the PRI. They've been around since 2006.
And the scale of this is just enormous, isn't it?
It really is. We're talking about signatories representing assets under management climbing towards, what, $120 trillion by 2021? Huge numbers.
So active ownership. It's not passive then.
Not at all. It means intentionally weaving ESG considerations into everything they do as owners.
How so? What does that look like?
Well, it involves everything from having and openly disclosing detailed ownership policies.
So everyone knows where they stand.
Exactly. To actively exercising their voting rights, or if they outsource voting, making sure they monitor that closely.
They also engage directly with companies.
Yes, sometimes behind the scenes, sometimes more publicly. They might get involved in shaping broader policies.
Or even file their own shareholder resolutions on ESG topics.
Precisely. And collaborate with other investors on these issues, too.
It sounds like it's often a kind of escalating process.
That's a good way to put it. Engagement might start quietly, a letter, a meeting.
But if that doesn't yield results,
Then voting becomes a much more public and pointed form of pressure.
okay. And how do these huge investors actually decide how to vote on all the items that come up? There must be hundreds sometimes.
That's where the detailed voting policies come in. These are pretty extensive documents.
Laying out their approach.
Exactly. How they'll vote on different types of proposals. Think of Norway's sovereign wealth fund, Norges Bank Investment Management, or big asset managers like State Street Global Advisors, Amundi.
They all publish these.
Yes, they do.
Yeah.
And while you see common threads, they can also reflect genuinely differing perspectives or, ideologies on certain issues.
And adding another layer here are the proxy advisors.
Right, a crucial layer. These firms provide research and voting recommendations to investors.
The two big names everyone mentions are Institutional Shareholder Services, ISS, and Glass Lewis.
They typically offer a default benchmark policy, but ISS, for instance, also has a whole menu of specialty policies.
Tailored to different views.
Yeah, catering to different investor philosophies, socially responsible investment, sustainability, faith-based, climate policies, covering many regions globally.
This raises an interesting point, though, about the sheer concentration of voting power with these massive asset managers. They hold huge stakes across so many companies.
There's definitely been scrutiny around that, and it's led some, like BlackRock, to introduce what they call voting choice programs.
Also known as pass-through voting.
Exactly. It allows their largest institutional clients, the actual asset owners, like pension funds, to bypass BlackRock's own default policy
And choose something else.
and choose from a range of third-party policies, usually from ISS or Glass Lewis.
So what kind of options do they offer?
BlackRock offers quite a selection. The ISS benchmark, sustainability, SRI, various faith-based or pension fund policies, plus Glass Lewis's benchmark, climate, ESG policies, others too.
Wow, quite a menu.
They even provide these heat maps to visualize how the different options tend to vote compared to management recommendations on various proposal types.
But in practice.
Well, it's worth noting, the asset manager's own default policy is still the one most widely applied across their broader client base.
Okay, so we've got the guiding principles like active ownership, the detailed policies, the proxy advisors influencing things. What are the actual types of votes shareholders cast, and how do the mechanics work?
Broadly, you can categorize votes by who proposes them. Either the company's board, those are management resolutions,
Or the shareholders themselves?
shareholder resolutions.
And the impact can differ too, right? Binding versus advisory.
Exactly. Binding means the company must implement the resolution if it passes. It's legally required.
Whereas
Advisory is where shareholders offer advice. It isn't legally mandatory. But a strong advisory vote still carries significant weight. Think, say, on pay in the U.S. That's a common advisory vote.
And the board usually weighs in.
Almost always. They provide their recommendation on how shareholders should vote on each item.
And the meeting rules themselves matter too.
Oh, absolutely. Who can call a meeting, who sets the agenda, the voting system used, the majority required simple 50%, maybe 2/3, even 75%. All critical details.
If you think about the simplest model of corporate power, it flows from the owners, the shareholders,
Who delegate to a board of directors.
who then delegate to the chief executive.
Right. And certain fundamental decisions absolutely require shareholder approval. How they're treated varies by jurisdiction, though.
Like what kind of decisions?
Things like changing the company's core rules, the corporate charter, voluntarily delisting from an exchange, issuing new stock, which dilutes existing shares.
Major deals too. Acquisitions, mergers.
Yes, acquisitions, divestitures, mergers, adopting takeover defenses like poison pills, and those advisory votes we mentioned on executive pay or even climate strategies, sometimes called, say, on climate.
Let's dig into one of the most fundamental votes, first electing the board members.
Definitely. This is the main way shareholders delegate power and, importantly, hold directors accountable.
And it's fascinating how different countries approach this. So let's start with the UK.
Okay, take BPL-ishly in 2020 as an example. In the UK, individual directors, including the CEO and CFO, face election every year, annually.
And they use majority voting.
Yes. A director needs over 50% of the votes cast for them to get elected.
And at that BP meeting in 2020,
Most directors sailed through very high approval, often well over 90%. The CEO got, I think, 99.67% for...
but the system allows shareholders to signal displeasure.
Exactly. If you're unhappy with strategy or pay or something else, you can vote against a specific director, maybe the chair of the relevant committee, or even the board chair.
And what's considered a weak mandate?
Generally, support below 2/3 can be seen as a sign that a director lacks strong backing.
Okay, now the United States, generally seen as more board-centric.
Typically, yes. Board election is usually item 1, right at the top of the agenda. At ExxonMobil's 2020 meeting, you could vote for, against, or abstain for each director.
And approval rates there.
Also quite high on average, over 93% in that 2020 example.
But then things changed at ExxonMobil.
Oh, yes. Fast forward to the 2021 meeting, and it was a very different picture. They moved to plurality voting for directors.
Plurality, how does that work?
On the proxy card, you suddenly couldn't vote against a director. Your options were for all, withhold all, or for all except specific names.
And under plurality.
The candidates with the most for votes win. Critically, they don't need a majority. Even if they only get, say, 40% support, if that's more than anyone else, they're in.
Wow. And this change happened alongside something else significant, isn't it?
It absolutely did. It coincided with a major proxy contest launched by an activist hedge fund, Engine Number 1.
They were focused on climate strategy.
Yes, they were deeply concerned about ExxonMobil's approach to the energy transition. And they didn't just complain.
They put their own candidates.
Exactly. They issued their own proxy card and proposed 4 alternative director candidates to replace incumbents, specifically targeting 4 existing directors.
So a head-to-head fight for votes.
A real battle. Both sides campaigned heavily, soliciting proxy votes, and the outcome was pretty remarkable.
What happened?
3 of Engine Number 1's nominees were elected. They actually displaced sitting directors.
That's a huge deal.
It's a prime example of how hedge fund activists in the U.S. use these proxy contests to gain board seats and try to force strategic change.
Okay, let's hop over to France. Total Energies in 2021 is an example here.
Right. In France, board elections might appear later on the agenda. And a key feature in many French companies is the staggered board.
Staggered, meaning not everyone is up for election each year.
Exactly. Directors often serve multi-year terms, maybe 3 years, and only a portion, a class of the board is up for election annually.
So at Total Energies in 2021.
Despite having a larger board, only 4 directors were actually up for renewal that year.
And the effect of that structure.
It makes it significantly harder for an activist to gain control of the board quickly. You'd need to win seats over multiple election cycles, maybe 2 or 3 years.
And the results at Total Energies.
They showed varying levels of support. The chairman and CEO, for example, received about 77.39% support for renewal, not the near unanimity seen at BP.
Now, Italy has a really unique system, doesn't it? List voting.
Yes, quite different. Seen at ENI in 2023, for example. Shareholders submit entire lists of director candidates.
You vote for the whole list.
You vote for a list, yes. The system is designed to provide proportional representation. Meaning minority shareholders can get seats on the board based on the percentage of votes their list receives. It's not winner take all.
Interesting. And the chairman?
The chairman might also be elected directly by shareholders. At ENI in 2023, directors were appointed from lists submitted by the majority shareholder, which is the ministry.
The Italian state.
Yes. And also from a list submitted by a minority group of institutional investors. The chairman came from the ministry's list.
There must be debate about that system.
Oh, absolutely. Some see it as fairer, preventing a single dominant shareholder from controlling the entire board. Others worry it can lead to a less cohesive, maybe more fragmented board. Directors usually have multi-year terms here, too.
And just to circle back on staggered boards, we saw them in France, but they exist elsewhere, too.
Yes. Some U.S. companies use them, like Tesla, although Tesla uses majority voting within its classes. But the core idea is the same, dividing directors into classes with multi-year terms.
And only one class is up each year.
Right. It's a significant takeover defense because an activist needs at least 2 successful annual meetings, sometimes 3, to secure a board majority. At Tesla's 2024 AGM, for example, only 2 directors out of 9 were up for election.
Okay, so beyond electing the board, what other kinds of proposals do companies typically put to shareholders?
Well, in the U.S., a very common one is the ratification of auditors.
Choosing the external auditor. Why is that put to a vote?
It's seen as absolutely critical for ensuring the independence of that auditor. A painful lesson learned from scandals like Enron, where the auditors were too close to management.
Right. And we saw this vote at both ExxonMobil and Tesla in the examples.
Exactly. Another very frequent U.S. proposal, which came in after the financial crisis, is the advisory vote on executive compensation.
Say on pay.
That's the one. It gives shareholders a non-binding vote on the executive pay packages.
Again, advisory, but sends a signal.
A strong signal. Both ExxonMobil and Tesla had these votes. Tesla's 2024 Say on Pay actually received over 80% support.
But it's not just these routine items. Sometimes companies propose fundamental changes, right? Changes to structure or rights.
Absolutely. And these often require specific approval, sometimes with higher voting thresholds than a simple majority of votes cast.
Tesla's 2024 AGM seems like a hotbed of examples here.
Yes, it really highlights the complexities and the high stakes involved. One major proposal was redomestication.
Moving the company's legal home.
Yes, moving from Delaware to Texas. It was presented as moving Tesla to its home state.
And the voting requirement was unusual.
It was tough. Not just a majority of votes cast, it needed a majority of all outstanding shares and a majority of disinterested votes cast.
Disinterested meaning?
Specifically excluding shares held by Elon Musk and his brother, Kimball Musk.
Did it pass?
It did. It got around 63% of all outstanding shares and 84% of those disinterested votes cast.
And Tesla actively pushed for this.
Oh, yeah. They didn't just put it on the ballot. They ran a significant campaign to solicit votes, launched a website, used social media like X, formerly Twitter.
And there was another huge one at that meeting, the pay package.
The second highly significant proposal, the ratification of Elon Musk's 2018 CEO Performance Award, valued at around $56 billion.
Now, hadn't shareholders already approved this once?
They had back in 2018, but that approval was later invalidated by a Delaware court judge.
Right.
The judge found the original approval process was flawed, essentially saying the board wasn't truly independent, that it was captured by Musk.
So Tesla put it to the shareholders again.
Yes, seeking re-ratification. This was recommended by a special committee of the board, with the Musks recused from the decision.
And the voting requirement here. Also complex.
Yes. Again, multiple majority thresholds, crucially including a majority of disinterested votes cast.
And the outcome.
It was approved again. Received around 77% of total votes cast and about 72% of the disinterested votes cast.
Similar campaign effort for this one.
Absolutely. Just like the Texas move, both Tesla and Elon Musk engaged in extensive campaigns to get the votes out, using various methods, even QR codes on materials to make voting easier.
They must have engaged with the proxy advisors, too.
They did. Tesla actively argued against Glass Lewis's recommendation to vote no on the pay package. ISS, on the other hand, recommended voting yes on both the Texas move and the pay ratification.
How did the big institutions react? Was there consensus?
Not at all. Reactions were really varied, which highlights the different perspectives out there. Norges Bank, the Norwegian fund.
They voted for the Texas moves.
Yes, but against the pay package. They cited its massive size, the structure, dilution, lack of key person, risk mitigation. A whole list of concerns.
And BlackRock.
BlackRock voted for both the Texas move and the pay package. Their reasoning was that the performance milestones were met and significant value was created. Though, interestingly, they did vote against the election of one director, citing concerns about the board process related to the pay package.
What about other big players? CalPERS.
CalPERS, the big California pension fund, reportedly also voted against the pay package, and that drew some very public criticism.
It really underscores that original Delaware court ruling, doesn't it? The judge calling the sum unfathomable and the process deeply flawed.
It absolutely does. It shows how the mechanics and the process behind the vote are just as critical legally and ethically as the final tally itself.
Okay, so we've covered votes proposed by the company. But shareholders aren't just reactive, right? They can propose things too.
Exactly. They aren't passive players waiting for the ballot. They can put forward their own resolutions.
But there are rules around that. It can't be a free-for-all.
No, the requirements for filing proposals vary quite a bit depending on the jurisdiction where the company is legally based.
What kind of requirements?
Different percentage thresholds of voting rights needed, or minimum shareholding amounts and holding periods. The rules try to balance shareholder access with preventing, an overwhelming number of frivolous or disruptive proposals.
How does it work in the United States?
In the U.S., under SEC Rule 14AA, shareholder proposals are typically advisory, not binding.
Okay. And the threshold to file?
It's relatively low, financially speaking. Holding just $2,000 worth of stock for 3 years, for example, can be enough. The process itself is relatively inexpensive for the shareholder.
But they don't all get on the ballot.
No, proposals are screened first by the company, then potentially by the SEC staff. Some get excluded based on specific rules if they relate to ordinary business, for example.
Does that low threshold lead to more proposals?
It definitely contributes to a high volume of proposals covering a huge range of topics. Looking at data from, say, 2019 to 2024.
What kind of topics come up?
Hundreds of proposals filed on issues like DEI, diversity, equity, inclusion, and human capital management, climate change, lobbying and political activities, human rights, a very broad spectrum.
And how much support do these typically get?
Support levels for these social and environmental proposals in the U.S. have fluctuated. They seem to peak around 2021, with median support near 33%.
But that's declined.
Yes, significantly. By 2024, the median support was down to around 18%, and the percentage that actually passed, getting over 50%, has remained quite low. It was basically 0% in the 2024 data points reviewed.
But even if they don't pass, can a strong showing still have an impact?
Yes, absolutely. A strong vote, even if below 50%, exerts pressure. Take ExxonMobil's 2021 meeting again.
What happened there?
Shareholder proposals asking for reports on lobbying generally and specifically on climate lobbying both passed. They got over 55% and 63% support, respectively.
And did ExxonMobil respond?
They did. Following those votes, the company produced a report detailing its climate lobbying activities, so the vote prompted action.
Now, there's been another trend recently, hasn't there? Anti-ESG proposals.
Yes, that's a notable development in the U.S. landscape. Proposals that actively seek to block or even reverse company efforts related to ESG issues.
Are there many of those?
Their volume has grown quite significantly in the last few years. However, median support for them remains very, very low.
How low?
Typically below 2%. They're often filed by specific groups, like the National Center for Public Policy Research.
Is there any difference in how these get treated in the screening process?
Well, some observations suggest that under recent SEC guidance, maybe fewer anti-ESG proposals are being omitted by companies compared to certain pro-ESG categories. It's a complex and evolving area.
Okay, let's compare that to the UK system for shareholder proposals.
It's quite different. In the UK, shareholder proposals operate under the Companies Act. They have a different legal basis.
Are the thresholds different?
Yes. Generally higher thresholds for filing. You might need supporters holding, say, 5% of the total voting rights.
But there's a key difference if they pass.
A critical difference. If a shareholder resolution passes by a majority vote in the UK, it is typically binding on the company.
Legally binding, unlike most U.S. proposals.
Exactly. Organizations like Share Action actually provide guidance specifically on how to file these legally binding UK resolutions.
And activist campaigns often use these proposals.
Yes, they're a key tool. Follow this. The Dutch NGO, they became well known for filing climate resolutions at major oil and gas companies.
What were they asking for?
Specifically asking companies to set greenhouse gas emissions targets aligned with the goals of the Paris Agreement.
How successful were they?
Support varied quite a bit. It reached over 30% at some companies in certain years, which is significant pressure, though support was consistently lower at ExxonMobil.
And they faced challenges.
Yes, including that lawsuit filed by ExxonMobil, which Follow this and others described as a bullying tactic, an attempt to silence them.
What was the outcome?
Ultimately, Follow This announced in April 2024 that it would be pausing its campaign, targeting the major oil companies, citing the challenging environment.
Now, speaking of activism, let's swing back to hedge fund activism in the U.S. Their focus is often different.
Frequently, yes. While they might use proposals, their main goal is often gaining actual board representation.
Like the Engine #1 campaign at ExxonMobil.
Exactly like that. Using proxy contests to nominate their own director candidates and directly challenge management for control of the board.
Is this common?
Research shows that the majority of proxy contests in the U.S. involve director nominations, and activist hedge funds are, by far, the most frequent sponsors of these contests. Their activity has really increased over the years.
Does the market react well to this?
Interestingly, yes, often. Studies have found that these contests are frequently associated with positive abnormal returns for shareholders around the time they happen.
Suggesting the market sometimes sees activist intervention as potentially value-enhancing.
It suggests the market perceives a potential for positive change, yes.
So voting is clearly a powerful tool, but it doesn't exist in isolation, does it?
Not at all. It's part of a broader toolkit. Organizations like Share Action actually outline how investors can use their influence strategically through what they call an escalation framework.
Escalation, how does that work?
It suggests a clear progression. You start with talk.
Dialogue.
Yes, business dialogue, maybe escalated meetings with senior management or board members, perhaps even making public statements challenging the company's strategy or practices.
And if talking doesn't work?
Then you move to vote. This means strategically using your voting power.
Oh.
Voting against management proposals, maybe key directors, or the executive pay package. Voting for relevant shareholder resolutions. Asking tough questions at the annual meeting. Maybe even pre-disclosing your voting intentions publicly to rally support, or formally filing your own resolutions.
Okay, talk first, then vote. What's next if that still doesn't achieve the goal?
The next step considers capital allocation decisions, potentially selling your shares, divesting, or choosing not to participate if the company tries to raise new capital, hitting them in the wallet, essentially.
And the final step.
Finally, there are levers of last resort. This could involve litigation, suing the company, or seeking regulatory intervention.
That framework really puts voting in context.
It does. It clearly shows how voting fits within a broader strategy of investor influence. It's not just a one-off tick box exercise, it's a potential escalation point.
Now, after going through all these mechanics, the different systems, the activism, the really critical question remains, does all this voting activity actually matter? Does it make a tangible difference?
Does it change corporate behavior? Does it create value? That's the million-dollar question, or maybe the multi-trillion-dollar question.
This next part is intricate, so let's pause here. Think of it like this. Academic research has tried to get at this, to isolate the causal effect of shareholder votes. It's tricky.
It is tricky, but there's a really notable paper by Cunhat, Jean, and Guadalupe, published in the Journal of Finance. They used a clever methodology.
What did they do?
They used something called regression discontinuity design, RDD.
Okay, what does that mean in plain English?
Basically, they looked very closely at shareholder proposals that barely passed or barely failed, right around the 50% voting threshold.
Why focus on the close calls?
The idea is that whether a proposal squeaks by with 50.1% or just misses with 49.9% is almost random. It's like a natural experiment.
Ah, so it helps isolate the effect of the proposal itself passing rather than other things happening at the company.
Exactly. It helps separate correlation from causation, and their findings were pretty significant.
What do they find?
They found that passing a governance proposal led to statistically significant positive abnormal returns for shareholders. The market reacted
Oh,
positively.
now positive.
They estimated an average increase of about 2.8% in shareholder value per proposal adopted. That's not trivial.
Wow. Were there conditions where the effect was stronger?
Yes. This positive market reaction was larger for firms that had more anti-takeover defenses already in place.
Suggesting the vote helped unlock value trapped by those defenses.
Plausibly, yes. Also stronger for companies with higher institutional ownership, and when the proposal was sponsored by institutional investors themselves.
Did they look beyond the stock price reaction? Did it change company behavior?
They did. They found that following the passage of these governance proposals, companies tended to decrease their rate of acquisitions and capital expenditures.
So maybe becoming more disciplined with capital.
That's one interpretation. And they also found that the company's long-term operating performance tended to improve after these proposals passed.
Now, this was mostly based on U.S. advisory votes.
Primarily, yes. But the sheer size of their sample allowed for this robust analysis. It provides strong empirical support for the idea that shareholder votes on governance can have a real, measurable impact on company value and behavior.
So, stepping back, what does this whole deep dive reveal? It feels like we've traced a path here.
I think so too. We've seen a clear connection, really, from those high-level principles, responsible investment, active ownership,
All the way down to the specific, sometimes incredibly complex mechanics of shareholder voting. The nuts and bolts.
and those detailed voting policies, plus the recommendations from proxy advisors, they act as the crucial filters. They translate broad principles into actual voting decisions for these massive pools of capital.
And the system itself matters hugely. The choice of voting system, majority, plurality, list voting, the board structure, staggered or not, the rules for proposing resolutions.
Absolutely. They fundamentally shape the balance of power between the owners and the management. We saw that clearly in the distinct approaches in the UK, US, France, and Italy.
Then there's the activism. Proxy contests, especially in the U.S., seem like an intensified form of that power struggle.
They really are. Shareholders aren't just advising, they're directly challenging management for control of the board itself.
And the content of the votes reflects broader trends too, doesn't it? The rise of ESG proposals.
And more recently, that counter-movement of anti-ESG proposals. It shows how ongoing societal debates are playing out directly within the corporate arena, using the voting mechanism as the battleground.
And crucially, that academic research lends weight to the idea that this isn't just process, it's not just paperwork.
Exactly. It provides tangible evidence that shareholder voting can genuinely impact corporate strategy, operational decisions, and ultimately shareholder value. It matters.
Understanding how all these different pieces fit together, the principles, the policies, the mechanics, the activism, the research, it gives you a much richer picture, doesn't it? A picture of how companies are actually governed and influenced by their owners.
Definitely. We've journeyed through this really intricate world of shareholder voting. From those active ownership principles right through to high-stakes proxy fights and the measurable impacts shown by research.
It's clear that casting a vote, which seems like such a simple act on the surface,
It's actually part of a complex, dynamic system, a system of corporate governance and influence that is constantly evolving.
it really makes you wonder, doesn't it? In a world where information flows faster than ever, and you have these different, sometimes clashing investor ideologies,
Yeah.
how will the very nature of shareholder voting continue to transform?
What new strategies will emerge? How will companies and investors keep adapting to this changing landscape? It's a fascinating space to watch.
Thanks for joining us on this deep dive.
Ah.
Until next time, keep exploring.